What's up guys, my name is Craig Yeats. Welcome back to another video. We are here in the studio and I'm going to be sharing a couple of thoughts with you today on why I'm no longer going to be investing in property. But before you click off and think to yourself, hey Craig, I don't own any property, or I don't have any money to go and buy a property, just hang on a moment, because even though you don't own property or don't want to or do want to, I'm going to be sharing with you what's going on throughout the world, what's going on inside of South Africa. Hey, I might even talk about whether property is a good investment or a bad investment. But for me, I'm going to explain to you why I'm no longer investing in property. So it's probably best to stay right up until the end. Do you know what's always better than investing in property? Smashing that like button. So if you haven't yet, make sure to smash that like button. And if you haven't subscribed to my channel, now's the time to do it. Because on my channel, I teach all about investing, business, entrepreneurship, and having the right mindset for success. In 2019, I came across an article by CNBC that said, investing in real estate is still the best investment you can make. Well, 2019 is now a long time away because we are coming to the end of 2021 and everything has changed. And I'm going to go through it in this video. I'm going to talk a little bit about why I do like property, why I don't like property, and why now is not the time to invest in property. So one of the main reasons why I wanted to make this video is because inflation is having a big impact in the US and throughout the world. You know that old saying, when the US sneezes, the rest of the world catches a cold? Well, that is what's happening with inflation now. So where did inflation actually come from this time around? And it comes from this picture. So what do these cars have to do with it? What do these cars have to do with inflation? Well, if we go back to the beginning of 2020, when COVID first hit, the first 2 months of COVID, because of the lockdowns, saw the US lose 22 million jobs. 22 million jobs has a big impact on the economy, because what that leads onto is people not going out and shopping and spending money. So retail sales dropped through the floor. US government, really intelligent, decided, what do we need to do? We need to stimulate the economy. We need to go and pump money, pump a stimulus into the economy to get people to spend money again. So they did that, and it had a big impact on the economy. It made people go out and shop because they had more money in their bank accounts and they weren't working, they weren't at home, they weren't driving their cars. And then, as soon as they could get out their house, they wanted to go and drive. They wanted to go and spend that money. So they went to go buy new cars. But there was one problem. China was in a lockdown and they weren't in their factories making microchips. So there were no new microchips to go into the new cars. So people wanted to drive, they wanted to buy new cars because they wanted to get out of their house and buy and shop, but they couldn't buy new cars because there were no microchips. And that's why these cars were just sitting around and no one could buy new cars. So what did they do? They went to buy secondhand cars and trucks. And with that, the demand skyrocketed through the roof. So there was a huge demand for secondhand cars, but supply remained the same. Because if you think about it, if you own a secondhand car dealership, you won't just have enough space for the demand coming in, so you have the same amount of stock, but a greater demand. So what does that mean? They increase prices. So that increase in price actually has an impact on us here in South Africa and our inflation, because they kept putting the prices up of secondhand cars, had a knock-on effect of inflation inside the US, and therefore it has a knock-on effect here in South Africa. Can you believe how crazy that is? They stimulated the economy. They overcorrected what they should have done because people spent more than they spent before COVID, but unemployment is still not back to where it was pre-COVID levels, which is rather interesting. One of the only ways governments are able to combat inflation is to play around with interest rates, to increase or decrease interest rates and the money supply, which will affect inflation. If we go back to 2008 and the 2008 crash, the governments had to step in and quickly drop interest rates. They dropped interest rates because we were in a financial recession and they wanted to once again stimulate the economy. From 2008 up until the end of 2015, interest rates in the US remained close to zero. Then in 2016, interest rates slowly but surely started to go up until COVID hit. And when COVID hit, once again, interest rates were completely dropped back to zero. So interest rates are now at an all-time low, which has been great for going out and shopping and buying real estate. Because interest rates are low, it's easy to get money, and money is cheap to go and buy property. But we are now at the bottom of an interest rate cycle. So what does that mean? If interest rates go up, the property that you live in, your investment properties, will go up every single month because the costing is going to go up on your bonds or your mortgage payments. In South Africa, unemployment is ridiculous. We have an unemployment over 30% throughout the country. But the scariest thing for me is that people between the ages of 25 and 34, we have an unemployment of 52%. 52% of people in the prime of their life that should be working, should be adding to the economy, should be adding value to the world, are unemployed. So that's a scary thing to think about. What is going to happen in South Africa and our economy with the big working force being unemployed? On top of that, people aren't investing back in South Africa. The governments are not investing in fixed investments in South Africa. So the public sector aren't investing, but the private sector are also not investing as much as they should. The public sector should be investing 10% of our percentage of GDP into fixed investment to stimulate the economy. And right now, they are only investing 5%. So half of what they should be. When we look at private sector should be investing 30% of their percentage of GDP back into South Africa. And right now, those numbers are sitting around 15%, which is scary. There's no fixed investment taking place inside of South Africa. We have the majority of our youth that are strong, that are fit, that are healthy, that should be working, and half of them aren't working, which is incredibly scary. And as you can see, our fixed investment in South Africa is low. It means business confidence is low. When business confidence is low, people aren't comfortable going out and spending. We need people to spend. That's what the governments in the US knew. That's why they stimulated the economy, to get people to go and spend. So what are we looking at? We have a high unemployment rate. Both government and private sector aren't investing in fixed investments, meaning they're not putting money back into roads, infrastructure, development, actually investing in property. And we have foreigners that have always come into South Africa to buy our bonds and to buy our equities. Now we are sitting in a situation where they are net sellers of bonds and equities. So they're pulling money out of South Africa to take it back offshore. We've always been a country that has higher interest rates than the rest of the world. So it's been an attractive place for people to come and invest, as foreigners want to find the best interest rate. So they've always invested here. Right now, foreigners are net sellers of bonds and equities, which is rather scary. So we've got inflation throughout the world that is starting to hit, and that is coming here to South Africa. So what does our South African government do? Well, one of the only things they can do, they have to start increasing interest rates. So the next Monetary Policy Committee meeting takes place on the 18th of November. The consensus is this is going to be the first rate hike in a very, very long time since COVID hit. So the consensus is that interest rates will go up here in South Africa by 25 basis points. So it might be the first time people that are sitting in debt on their properties, their cars, their credit cards are going to start paying a little bit more. Now, most people in South Africa are already squeezed when it comes to their finances. Now to go to them and say, whoa, you're already in a tough time. We are now going to start increasing interest rates. It's going to have a knock-on effect on so many South Africans. And if only 50% of people between 25 and 34 are actually working, the percentage of people that are going to be impacted that are contributing to the economy is very, very high. So for me, it's a scary place to be, because as soon as interest rates go up, people are going to have less money. It's going to have more of a knock-on effect to the economy. So there's a couple of reasons why I like property. Some of the reasons why I like investing in property is debt. Debt and other people's money. Those are the main reasons why I want to go out and invest in property. I want to borrow money from a bank via a bond, via a mortgage, and there's going to be interest associated with it. So I want other people's money, and I want a tenant to come and pay off my bond. So I need my tenants working, earning an income so that they can pay off my bond, and I need the interest rates as low as possible from the bank. So I need people working, and I need the bank. Now what's going to be happening is the bank is going to be charging me more every single month, and if the economy is getting squeezed, I might not have tenants that are going to pay my bond. So that puts me in a very risky position if I'm a property investor and owning property, because one of the main reasons why I like property is now getting squeezed by the bank and potentially squeezed by tenants. I have a situation at the moment where a couple of my properties have not had an increase in rent for the last 4 years. Right now, this month, I've had a property where I've had to drop the rent substantially in order to be able to get a tenant. For 1 month, the property sat completely vacant. So vacancy rates are very high at the moment. Vacancy for 1 month, and then the new tenant signed a decrease in what the previous rent was, which puts pressure on my pocket. 3 reasons why I don't like property. Number 1 is liquidity. You can't just quickly go and access your money from a property like you can in other forms of investments or unit trusts, shares, you name it. Second one is transaction costs. Both purchasing and selling have very high transaction costs. So even if I could sell the property right now and it was liquid, it means I'm going to lose money because of the expenses when I sell. And the third one is low returns, high expenses. Having a property right now, and as I've said, rents haven't gone up. Rents haven't gone up, but inflation is going up. So that means property expenses keep going up the whole time. So we are squeezed on the returns that we're getting, and expenses are going up the whole time. So those are 3 reasons why I don't like property. Like anything, a business or any type of investment, you go through different market cycles of going up and going down. And right now we're in the recession part of the property market. When I look at it, property is a great investment at times. Right now, we're not in the time where you want to be investing in property. There are 3 things that take place which make me want to step back from investing in property. 1 is the cash on cash return. So what I mean by that, if I'm going to go invest into property, I always want to look at the numbers. Do the numbers make sense? And if returns are lower now than they've been before, it's going to cost me a lot of money to purchase a property, and I'm not getting the return out of it like I would have in the past. So cash on cash is now a problem because of the market cycle we find ourselves in. The second one that I want to look at is vacancies. There are a lot of vacancies. I've had it inside of some of my properties, but if you look at it in commercial property, office space particularly, there's a lot of vacancies at the moment. People inside of Cape Town, where I live, has always been a hub for students. People want to come down to UCT, they want to come down to Stellenbosch. But now because of COVID, people aren't coming down to Cape Town to come and study here. So the vacancy for student accommodation has gone through the roof, and that's having an impact and a reason why there's no demand for property here in South Africa. And another interesting time is that when people say, this time it's different. And people have said that when the market's going up, when the market's coming down, and they say right now, this time is different. Whenever you hear that word, you know there's a problem. So those 3 points are when you want to get out of investing in property. Those are 3 main points on top of the economy throughout the world and inside of South Africa are reasons why I wouldn't want to be investing in property right now. Does that mean I'm going to go and sell my properties that I've invested in? No, it doesn't. Because in the long run, property will be a good investment. Right now, I'm not going to go and buy more property. But it doesn't mean I'm going to go and sell because I don't want to incur those costs of selling. So inside of anyone's property portfolio, or let's call it any kind of portfolio, investment portfolio, you need to look at certain things. One of them is your allocation of money to various different investments. Do I want to go invest in property right now? No. Do I want to go take out more debt right now? Definitely not, because we're going to start seeing interest rates go up. Now, this interest rate hike on the 18th of November might not be too high, but the forecast is that next year, interest rates will go up another 75 basis points, meaning the prime rate will be 1% higher in 2022 than it is right now in 2021. So I don't want to go and buy property. I don't want to invest in debt. Do I want to go and invest into cash? Well, interest rates are at all-time low. So no, I don't want to invest in cash either. So what does that leave me? Well, if I think about it, there's a couple of investments that I could invest in, which are simple, which are easy, which are getting good returns because the JSE as well as the American stock market are just getting higher and higher and higher all the time. So the best place for me to go and start putting my money right now is in unit trusts and retirement savings. If I can go and bolster up unit trusts and my retirement, now is the time to actually go and do it. Because at a certain stage, the property market will change again. When the property market changes and we move from a recession into a period of opportunity, I want to have cash available to go and purchase property. But why would I just sit on the sideline right now? Because you should never sit on the sideline because you're missing the opportunity cost. And right now, some of the best opportunities are sitting inside of share markets, inside of retirements, inside of unit trust investing. So now's the time where I actually want to move the money from going and investing into property into something like retirement, something like unit trust, which is simple to invest in, it's easy to invest in, and if I want to stop it or start it, I'm able to do so. So I have a lot of flexibility, unlike property, which is very illiquid. Even though this whole video has been on why I no longer want to invest in property, it doesn't mean I stop investing altogether. Because it's important to constantly be investing and maybe just change your asset allocation. But to turn around all this doom and gloom that I've spoken about throughout the world and in South Africa, there's a couple of good things that are taking place right now in South Africa. For one, our trade surplus is doing incredibly well. Commodity prices is the reason why our exports are so much higher than imports, which is good for our country here in South Africa. On top of that, SARS are very happy with corporates because corporate tax collection is higher now than it's ever been before. So those companies that have done well throughout COVID are making money, are in profits, and those are the companies that pay their taxes. So SARS are very happy because they are collecting on income tax from corporates, which is great. And the third thing is the government has revised the debt to GDP ratio, which is amazing. So it's not all doom and gloom here in South Africa. So on top of all of that, our COVID numbers are now getting lower and lower and lower. We've gone through the hectic third wave, and our numbers now are lower than they were before the first wave started to pick up. And vaccinations are getting higher and higher all the time. So we're in a good space, a good place emotionally. We're heading into summer. It's a great time to be alive inside of South Africa. People are getting more excited. They're going out, they're enjoying families, friends. We're heading into Christmas, we're heading into holidays. Whatever you do, make sure to stay safe. Whatever you do, make sure to constantly be investing. Whatever you do, keep learning. Keep watching videos. Keep learning from people like myself. I love teaching. That is why I'm here. That is why I'm talking to you. I hope you've got a lot of value out of this video. I hope you've learned something about property, something about the South African economy that you can use for your future endeavors in building wealth and becoming more knowledgeable in everything that you do. So if you have, I would love it if you smash that like button. If you share this with a friend, someone that needs to hear this message right now, because I don't know who needs to hear it, but there's a lot of people out there that need to hear it. Until next week, I'm out of here.